So in our last segment, we went over the most difficult parts of accounting, which is really analyzing the transactions and determining which accounts go up and down. In this section, we're going to start discussing how companies keep track of their account balances, and we're going to introduce the concept of debits and credits. Don't fret, just stay with me, trust that I can make this easy for you, and debits and credits will be a breeze. So first, as we determine which accounts are involved, we need to somehow track all the transactions going through the various accounts. And we're going to do that by utilizing a general journal, which will be a list of the journal entries. And that'll be basically the debits and credits that represent the up and down that we discussed in the last part with transaction analysis. We can also use T accounts to summarize the various transactions. T accounts basically would be like our shoe boxes that I mentioned earlier, where we put in various transactions that affect that shoebox or account. So cash would have its own T account, and then any journal entry, any transaction that affects cash would get posted to that cash T account. And I'll explain that in more detail in a little bit. And the general ledger is where we keep the final balances of all of our accounts. And those numbers are going to be used to create the financial statements. So what's the process of the accounting cycle? Well, we start with analyzing the transactions, and that is what we just went over in the last segment. And analyzing the transactions, I would argue, is the most difficult part, because when you're analyzing transactions, you're determining which accounts are involved in the ups or downs. Converting it to debit credit format and creating a journal entry is very easy once you go through step one. And then posting the entries to the general ledger or T account is even easier than that, because once you figure out your debits and credits, it's just a function of putting it on the left or right hand side of the T account, as we'll learn in a bit. The way I remember these steps is it's analyze, and then I call it journalize for number 2. And then 3 is post. So it's analyze, journalize, post. And then at the end of the accounting period, there's still some additional steps that we need to perform, and we'll discuss those steps in Chapter 4, and that's preparing a trial balance, which is a basically practice run to make sure debits equal credits before we prepare the financials. Making any adjustments needed at the end of the period to fix our revenue and expense balances. It's possible at the end of the period that we've earned some revenue that we haven't recorded, or that we've used some expenses that we haven't recorded. So we need to make those adjustments, and we'll learn more about that in Chapter 4. And then we prepare the financial statements, disseminate them or give them out to the users, and then we close out our revenue, expenses, gains, and losses to retained earnings and start the process over again. We'll go through all of those concepts in Chapter 4, and we'll probably touch upon some of them even in Chapter 3. But right now, what we're going to focus on is those first 3, analyze, journalize, and post. We've analyzed transactions that affect the balance sheet. Now we're going to move on to learning how to journalize and post them. So this is the transaction analysis model, and it's what I would call your accounting to English or English to accounting conversion guide. So if you ever learned Spanish, you might know how to say hello in Spanish. It's hola. And when you learn that, I'm sure you didn't say, but why is it hola? You just accepted that the translation from hello in English to hello in Spanish was hola in Spanish. And that's what you need to do in order to understand debits and credits. Debits and credits are just the accounting terms that tell us the up and the down of the various types of accounts. So this transaction model here focuses on our balance sheet equation, assets equal liabilities plus equity. But I'm going to go through and give you an example that includes everything. So we're even going to include the expansion of retained earnings that is covered by the textbook in Chapter 3. I think including it now would make a lot of sense. So if we were in class face-to-face right now, I would tell you to make sure you write this down and that this is going to be really the most important thing you learn during the semester. This conversion guide is going to be used throughout the entire semester whenever you're trying to come up with journal entries. I want you to always think in English first. I want you to think what go up, what go down. Remember that caveman, cavewoman speak. And then just use this conversion guide we're about to go over to convert it to debits and credits. That makes it far, far more easy to understand. So first, just logical thinking in English, then convert. So what's the conversion guide look like? Well, it's A equals L plus E. And then we'll do our income statement, revenue minus expense equals net income. And then below each of those items, I drew T's. And then under equity, I'm going to break it up into contributed capital and retained earnings. The amount from the shareholders and the amount we've earned and keep. And those T's are called T accounts. So we mentioned T accounts earlier. That's all it is. It's a letter T. And the reason it's a letter T is that we have two sides, the debit side and the credit side. And the way I remember this is I just think of the capital of the United States, which is Washington, D.C. So it doesn't matter where we are on the accounting equations, whether we're on our balance sheet or whether we're on our income statement. This is our balance sheet. And this is the income statement. Debits are always on the left, credits are always on the right. Also, I want to add one more T account under equity, specifically under retained earnings, and that would be dividends. Because remember, dividends would be giving out some of your retained earnings to owners. So then, in order to finish this conversion guide, all I need to do is figure out which accounts go up with debits, down with credits, and which accounts do the opposite. So the way I remember it is I think of the word dead, because you'll be dead if you don't know this for the exams and quizzes. Dead really stands for debit, expenses, assets, and dividends. So those three accounts are the ones that are going to go up with debit and down with credit. Everything else is going to be the opposite. So when you whip out this conversion guide, you just got to think of the word dead, where we debit expenses, assets, and dividends to make them go up, which means they go down with credits. So it's going to be debit goes up, credit goes down for expenses, assets, and dividends. Then everything else is going to do the opposite. So the opposite of up, down would be down, up. And there you have it, your conversion guide. So we'll go through some examples of this later, but for now, if you know cash is going up, that's the English, right? We figured out cash is going up. All you have to do is look under assets, because cash is an asset. And then you could see the up arrows under debit. So you can speak sweet, sweet accounting to me now. You could say cash would be debited. That's the same as saying cash goes up in English. And then the same would hold true for, say, revenue. If revenue is going up, you'd look under revenue and you'd see that's a credit. So in accounting language, revenue going up is a credit. The benefit of using debits and credits is it provides us with another check to our work. Remember, assets have to equal liabilities plus equity, but when we journalize these transactions in debits and credit format, it gives us another double check because debits also have to equal credits. So it's a second way that we're able to check our work. Again, first, think logic, think up, down, what the wording we're comfortable with. Then use this conversion guide throughout the semester to convert those up-down transactions to debits and credits. And debits and credits will be the easiest thing you ever do. It's simply a conversion. Hello. Hola. Just a conversion. English to Spanish. And that's what we're doing here. English to accounting. So this is what a journal entry looks like. it's not overly exciting. The most important takeaways are we have our account names, the various accounts that are affected, listed, and then all the credits get indented. So that's how we differentiate between debits and credits. We indent the credits because credits are on the right of a T account and debits are on the left. So rather than writing cash goes up $3,700, common stock goes up $100, and additional paid-in capital goes up $3,600, we can simply do this journal entry, and it tells us exactly that. The fact that cash is on the left means it's debited. Debits make assets go up if you look back at your conversion chart. And then our equity accounts, common stock, and additional paid-in capital also go up with credits. So all this is accounting shorthand. So rather than writing the ups and the downs, we do that in debit and credit format. Once we have our journal entry, the posting process is very, very simple. You have to shut down part of your brain to handle it, actually. Okay, because otherwise you'll think you are. We see $3,700 cash. It's on the left-hand side, meaning a debit. You put it on the left-hand side of your T account for cash. You have your $100 and your $3,600 for common stock and additional paid-in capital. It's on the right, so you put it on the right of the respective T accounts. Okay, that's all that you do. If it's on the left, put it on the left. If it's on the right, put it on the right. You're not doing any major thinking at this point. You're not thinking, oh, is it going up? Is it going down? None of that matters. You already did that hard work. First, you thought up, down at the very beginning when we analyzed the transaction. Then, we went through and used our conversion guide to journalize it as to a debit or a credit. And once that is done, all you got to do is shove it where it belongs. On the left, put it on the left. On the right, put it on the right. All the T account does is it allows us to track the different transactions that affect each account, and then allows us to add it up at the end so we can get a balance for each account. So you could see here with our cash and our common stock accounts, we're adding up the balance. So we had a beginning balance of $419. Transaction A adds $3,700 to it. How do I know it adds? Because cash goes up with debits, down with credits. Common stock is the opposite, down with debits and up with credits. So the way you add up a T account, I'll give you another example here. For cash, let's say, if we add 100, 300, and 400, and then 50 on this side, and another 100. What you do is you add up your debits, so 3, 4, 5, 6, 7, 8, $800. You add up your credits, 150, and then you take the difference. So the difference between 800 and 150 is 650. And then the bigger side wins. So because the debits had the bigger balance, that's where you put the ending balance on the debit side. And that should also be the side that makes the account go up. So it makes sense that cash would end up with a debit balance because that's the side that makes cash go up. This is called the normal balance of the account because it's the side that normally would have the balance. That's why it's called the normal balance. And the normal balance side of any account is always the side that makes it go up. So that's really all the T account is used for. The T account is used to summarize the effects of all the various transactions into the individual accounts. We can also use T accounts to solve for missing pieces. So with accounts payable, we have a beginning balance. Then if we buy stuff on account, that would add to our liability. And then when we pay it, obviously that decreases our liability. So we can use a T account effectively solving for X here, but I have yet to find a student that enjoys using T accounts. It's just not what we're familiar with. So usually the best solution is to convert the T account to algebra, which is what's done at the bottom. Our beginning balance plus purchases minus payments is our ending balance. How can I convert to the algebra? Well, I have to know my debit credit rules. Everything on the credit side is an addition to a liability, and anything on the debit side is a decrease. And then once we put in the information we have, we can solve for the missing piece. So we're going to go through a couple of quick examples converting our up-downs to debits and credits. Again, I'd recommend that you pause the video so you can try it yourself to make sure that you're following along and understanding the material. So this is the exact transaction we did in our previous segment where we went through transaction analysis. We did the hard part already, which is the up-down. We determined cash go up, and then common stock and additional paid-in capital go up. Remember, the common stock goes up by the number of shares times par, and then additional paid-in capital we learned went up for the difference between the total amount of cash received and the amount we put into the common stock account. So that hard work has already been done. All we have to do is journalize and post it. Well, to journalize it, cash goes up. You look at your conversion guide, and I highly recommend you do that. Look down at your notes at that conversion guide, and you'll see that in order to make cash go up, you debit it. And then we know our equity accounts go up, and if you look at your conversion guide, to make equity accounts go up, you credit them. So to do our journal entry, we end up debiting the cash and crediting the equity. How do I know I'm debiting cash? Because it's on the left. How do I know I'm crediting equity? Because it's indented. And then once I have my journal entry, I can verify that debits equal credits, and you could see that debits do in fact equal credits. The credits total $3,700, and there's only one debit totaling $3,700. So that's an additional check for us. And then the last part is shut off half of your brain because you're just going to shove it where it belongs. For cash, we're going to shove it on the left. For common stock and additional paid-in capital, we're going to shove it on the right. So we're going to post the cash to the debit side, the common stock and additional paid-in capital to the credit side. Notice the 1/115 balances. Those are balances that are from the beginning of the period. And then we're adding various transactions to that throughout the month or throughout the year. We're going to do the same thing with another transaction. We've done the hard part already in the last segment. We determined that when we borrowed money from a bank, both cash and long-term notes payable go up. So A equals L plus E. We already figured that out in a past transaction. Now we're doing the conversion. So just looking at my conversion guide, I know to make cash an asset go up, I debit it. And to make liabilities go up, I credit it. And frankly, once you know cash goes up with a debit, the other thing's got to be a credit because remember, debits have to equal credits. Once I do my journal entry, posting it, if it's on the left, put it on the left. If it's on the right, put it on the right of the T account. And that's all there is to it.